Have you ever wondered how to get rich off dividends? Well, you're not alone. Dividends are a fascinating and powerful tool for wealth generation. But what exactly are they? Simply put, dividends are a chunk of a company's profits that are shared out to its shareholders. Consider it as your slice of the company's success pie. But here's the catch. Dividends aren't just a one-time deal. Companies that pay dividends usually do so regularly, often quarterly. This means that as a shareholder, you have a steady flow of income that's independent of market fluctuations. Imagine a river that keeps flowing, regardless of the weather. That's the power of dividends. But the magic of dividends doesn't stop there. They can be reinvested to buy more shares, leading to a snowball effect of increasing wealth. So, intrigued about the potential of dividends? Let's dive into how you can start building wealth with them. To get rich off dividends, you first need to understand the basics of dividend investing. So, what is dividend investing? It's a strategy focused on buying shares in companies that regularly pay dividends. Dividends are a portion of a company's earnings paid out to shareholders, usually in the form of cash or additional shares. Now let's break down the key concepts of dividend investing. First, we have the dividend yield. This is the annual dividend payment divided by the stock's current market price. And it's expressed as a percentage and essentially tells you how much bang for your buck you're getting in dividends. A higher dividend yield can indicate a better return on investment, but remember, it's just one piece of the puzzle. Next, we have the payout ratio. This is the portion of earnings a company pays out to shareholders in dividends. It's calculated by dividing the annual dividend payment by the company's earnings per share. A lower payout ratio could mean the company is retaining more earnings for growth, while a higher ratio might indicate the company is generously rewarding its shareholders. But beware, excessively high payout ratios could be a sign that the dividend is not sustainable in the long run. Finally, there's dividend growth. This is the rate at which a company's annual dividend payment increases over time. Companies with a history of consistent dividend growth are often more stable and reliable investments. Now, not all companies pay dividends. Typically, well-established companies with a steady stream of income are more likely to distribute dividends. These companies have a strong track record of dividend payments, showing their commitment to returning value to shareholders. So we choose dividend investing. Besides the potential for regular income, it also encourages a long-term investment mindset. Rather than chasing quick profits, you're investing in companies that provide steady returns over the long haul. Now that you have the basics down, it's time to start building your dividend portfolio. Building a dividend portfolio is a strategic process that requires careful stock selection. Let's dive right into it. The first step is to identify companies with a history of stable and growing dividends. Stability is key here. You want to invest in companies that have consistently paid dividends over the years, even during economic downturns. These companies are often in sectors like utilities, consumer goods, and healthcare, which have steady demand no matter the state of the economy. But stability isn't enough. You also want to see growth in those dividends. Companies that increase their dividends year after year are demonstrating financial strength and confidence in their future earnings. This is a good sign for you as an investor, as it means your income from dividends will grow over time. Now let's talk about diversification. It's an investing principle that's as old as the hills, but it's crucial for building a strong dividend portfolio. Diversifying across different sectors and industries can protect you from potential losses. If one sector underperforms, your investments in other sectors can help offset those losses. Think about it this way: if all your eggs are in one basket and that basket falls, you lose all your eggs. But if your eggs are spread across several baskets, the fall of one basket won't be as devastating. The same principle applies to your dividend portfolio. Finally, don't forget to consider international stocks. They can offer additional diversification benefits and potentially higher dividend yields. Just be aware that investing in international stocks can come with additional risks, such as currency fluctuations and political instability. Building a dividend portfolio isn't a one-time thing. It's a continuous process that requires regular reviews and adjustments based on market conditions and your financial goals. It's not about chasing the highest yields, but about creating a balanced portfolio that can provide you with a steady income stream and potential for capital growth. With these steps, you are well on your way to creating a strong dividend portfolio, but the journey doesn't end here. The real secret to getting rich off dividends lies in the power of reinvestment and long-term growth. Let's break it down. When you reinvest your dividends, you're essentially using your profits to buy more shares of stock. And what does this mean for you? More shares equals more dividends in the future. It's a cycle that feeds on itself, creating a compounding effect that can significantly increase your wealth over time. Think of it this way: it's like planting a tree. The dividends are the seeds, and reinvesting them is like planting those seeds back into the ground. Over time, those seeds grow into more trees, which produce more seeds, and so on. This is the essence of compounding. Your wealth grows not just from your initial investment, but also from the dividends generated by that investment. Remember, getting rich off dividends isn't a get-rich-quick scheme. It's a slow and steady process. But with patience and discipline, it's a journey that can lead you to significant wealth.